I think great products actually exist at the intersection of the desirable, feasible, and viable. When you're at that Venn diagram in that moment, that's when really innovative, great products happen.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Manish Patel with us. Manish is the founder of Nava Ventures. He has over 14 years of experience in venture capital, helping startups secure Series A funding. He also led product teams at Google and teaches design thinking at Stanford. In this episode, we talk about Manish's story and how he got into investing, the investment thesis at Nava Ventures, how to apply design thinking to build great products, what makes a company Series A worthy, his biggest learning investing in startups over the years, and lots more. So, without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help VCs start and run their own podcast. While I was running VC 10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey Manish, so good to have you on the VC10X podcast. How are you doing?
Great, great, Prashant. Great to see you again.
Yeah, pleasure having you on the podcast. To start things off, can we first have your story and how you started Nava Ventures?
Yeah. So Nava is a new firm. We started in 2021. New firms as venture firms go, I suppose. It's been a few years now. Um, Certainly the accidental venture capitalist. I got into venture now about 14 years ago and fell in love with the craft. And, I never thought, if you asked me when I was 15, 16, would I ever be a venture capitalist, I would have said absolutely not. But it's just an amazing job. It's so humbling. It's such a job of privilege. It's so amazing to be able to work with entrepreneurs every day. And so I've been doing it for now the majority of my career. And before that, I was fortunate to be an early employee at Google. I was there right before the IPO in the book of life. Better to be lucky than good for sure. I was part of that company's kind of hyper growth journey and was able to build a number of great products and came out to the Valley now almost 25 years ago. My first year at university at Stanford was right after that dot-com bust, so in 1999. And I joined the faculty at Stanford almost a decade ago now in 2015.
Yeah, that's quite impressive. And you mentioned how at 15, 16, you did plan on becoming a VC. Honestly, I think most people don't even know what is a VC at that age. I didn't personally,
Yeah,
but yeah. Did
same,
you? Did you
same.
know that?
No, I
Okay.
mean, I even into my 20s was when I was working at Google, yeah, in the early days. I don't think I had a full appreciation of what venture capital was, I think people talk about it, and I think that even 20 years ago, I would say it was more of a boutique industry, and now I think it's really become a defined asset class. It's in the news every day. It's probably got its own section in like a lot of newspapers, and so I think it's very much defined in the same way that investment banking has become defined as an asset class, or that job is a thing. Most of the VCs I had met in my early career were people that were former operators. Rarely would you go straight into venture capital from university.
Absolutely. Yeah, completely agree. And tell me more about Nava Ventures. What are you trying to do there?
Yeah, so at Nava, we try to keep things simple. We do one thing, and that's Series A. That is our core focus. I think Series A is a really special time in a company's life, and we can talk more about that. And with that focus, we're able to really go deep, help companies in particular ways, and um, we are thesis driven as well as a firm. We managed just under a couple hundred million for our first fund, and doing Series A. There are a lot of different ways you can win. You could do many, many deals. You can do a few deals. We're definitely on the few deals kind side of the spectrum, really focused in how we operate. And that lets us go deep with companies. And it's just been amazing to see the fund perform over the last 2 years. And what we thought was just sort of an idea many years ago now really delivered. Being involved with companies that are really building fundamental technologies that impact the world. And we're very thesis driven in how we operate. Having strong points of view is very critical.
Absolutely. And let's talk about why did you decide to focus on Series A of all the other stages?
Yeah, so I think, great founders can will themselves kind of through grit, what have you, to 10, 20, 30 million revenue. I think that just sheer tenacity can get there. And I think in the Series A stage of a company's life, and I've done that most of my career, there's ability to build a foundation that is not just about the founder willing their way to success, but creates a flywheel. So if you build the right infrastructure, you think really deeply about the types of customers you want, the types of users you want, then there's a magical flywheel that starts to happen. So a founder that could have willed their way to 10, 20, 30 million revenue, now the company starts to have this flywheel effect. So that can grow to, 80, 100, 200, 300, even more in revenue. And I think that is the special thing about Series A investing. When you think about seed investing, it's still very much, an idea. Let's try to see if we can get some traction around this, still can be kind of very broadly defined in what you're doing. Just let me hire some few people and get some momentum. And Series B, I think, is very much about acceleration. It's just like, okay, the widget I built is working. Let's go faster. Let's just kind of rinse and repeat and go grow, 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 grow. So I think that Series A stage is very special, and it's still in this kind of world of defined asset class and venture allows for that kind of craftsmanship, sort of artisan approach, versus just like, well, here's a standard playbook, go execute that playbook.
Yeah, absolutely. And let's talk about the other aspect of the thesis to take
Yeah.
high conviction bets and a few of those instead of spreading it across a lot of companies.
Mhm.
So both are different risk reward profiles. So how did you decide that okay, we want to take higher conviction bets, just a few great companies, and not try to spread too thin across a lot of companies?
Absolutely. So it was very intentional. And, one of the things I love about venture capital, a lot of things I don't love about it. The one thing I do love is being able to work with entrepreneurs closely. And if you're working with if you're sitting on 50 boards or working with, 100 entrepreneurs, it's really hard to get in the weeds and work with them, right? And I really admire seed funds and that strategy, but, you can't there's only so much time in a day, right? And so if you really want to understand, what's going on with the company, you have to really think about, okay, well, how much hours do I want to spend every week thinking about this problem, thinking about this space, and thinking about this company? And so we're a small team here at Nava. It's a 9-person team. And we really wanted to be intentional about the companies we work with. And so by design, we said, hey, let's really be focused. Let's only invest in a few areas. We're a generalist fund by design, but we do 4 to 6 different theses at a time and always exploring new ideas. But that allows us to say no to a lot of stuff. And then when we say yes, we can say yes in a really big way.
Absolutely, and give me an insight into how you think about how involved you want to be with the company, because again, there are two approaches to venture capital investing. There are investors who are just giving you money and you can run
Oh,
with
yeah.
it, and then there are investors who want to be more involved. And then in that also there is to what degree can you be involved in that, or you want to be involved in that, right? So give me an insight into that.
Yeah, absolutely. I always tell my management teams and CEOs, if I'm making the hard decisions, then we're gonna fail. Like that's your job as a management team, as a CEO, as a leader. You have to make those hard decisions. My point of view is, look, I have more of a horizontal approach. I can pattern match. I don't think history repeats, but it does rhyme. I've being in the industry for a long time, having built large products at scale, a lot of great learnings from that can then inform product decisions. And so by being involved, my job is to really help founders uh, at the end of the day, become their best self and make good decisions and provide context sometimes when they don't have that context. The things that really drive us here in Nava, our culture, is defined by three core values: kindness, truth, and hustle. Kindness is kind of a funny one. You don't hear that a lot in venture capital. And from a culture of kindness, you can learn to become your best self, learn to become a taker of risk. And I think in a very rigid culture, which oftentimes many capital firms are, I think people are afraid to take risk. You're afraid about your boss, you're afraid about your board members. I think from our perspective, you can really start to evolve and become your best self. And that's also goes back to this idea of why Series A. At Series A, I think founders often still have quirky points of view on the world, and we want them to lean into that. This weird thing I've observed in venture over the years. The more capital you raise, sometimes the more bland your thinking becomes. You become more of an average. All of a sudden, you start listening to the market or bankers or others versus really trusting your instincts or what the customers say.
Absolutely, totally agree. And let's talk about design thinking. That's
Yeah.
where some of your background comes in from. I think you also teach design thinking at Stanford.
Mhm.
So do tell our listeners how do you apply design thinking to maybe building startups, or how you are applying it to building a venture capital firm.
Absolutely. So design thinking is kind of a problem solving approach at the end of the day that really helps people to have clarity and then ideally create something novel and innovative in what they do. It's a practice that's been around for 50 years. The class I teach at Stanford's been around for about 40 to 50 years, and it's been great to teach it for the last decade or so. But how does that apply to venture capital and startups? I would say at the highest level, is very much about problem defining versus problem solving. I think a lot of people spend a lot of time on problem solving, and that's not good. I think you got to upfront spend much more time on problem defining. I think there's this great quote from Albert Einstein that if I had an hour to solve a problem, I'd spend about 50 or 55 minutes thinking about the problem, and then about 5 minutes thinking about the solution. So if I ground that in a real world example, we talk about the airline industry today, right? If I want to go take a flight to Delhi, right? Everybody's like, "What's the shortest flight? What's the shortest flight?" I was like, "Well, okay, that's assuming a lot. You're giving a solution already about short flights, right? But maybe if the flight was very luxurious, you wouldn't want to get there so fast. Maybe if you're going to Delhi, you're like, oh, it's like like an Emirates flight, or it's like a spa in the sky. It's like, oh, I don't mind the long flight from San Francisco because it's quite enjoyable and quite relaxing. I want a longer flight because it's very, like a spa. And I think that's something that I really spent a lot of time thinking about with startups and also with the venture capital of like, how do you redefine the problem? What is a different way to to think about what's the really underlying root of it? So that's sort of one example. And then I think that then translates to like how people build great products, what actions they take, etc. But spending a lot of time redefining the problem is critical.
Absolutely, completely agree, and especially on the flights point. Whenever I'm faced with the option of short duration, bad flight versus long duration, a good airline, I would always go with a long duration. So
Hmm.
that's certainly there, right? Uh, awesome. Now let's talk about how do you build great products.
Yeah, yeah. I think this is important because sometimes people say, "Oh, it's subjective." It's this kind of this lightning in the bottle. I don't know how it happened, and it's just miraculous. This great product happens. I really disagree with that, and that's part of what I teach at Stanford is like, how do you think about what makes a product great, and what's a framework you can use, right? The devil's in the details, so to speak, right? It's about execution, but like, what's a framework you can use to think about how to build great products? And the way I think about it is a Venn diagram of three circles. There's the human side of it. So, is this product desirable? Do I want it? Right? Does somebody really want this in their life? There's the technology side of it. Of is it feasible? Does the technology exist for this to even be the case? So, for example, if I want to build teleportation, does that technology even exist today? Right? If I want to build a teleportation experience. And lastly, on the business side, is it viable? Is it something that's cost effective? Do I have to have everything made of titanium and gold and diamonds, et cetera, to make this thing work? If so, those are all important considerations. I think great products actually exist at the intersection of the desirable, feasible, and viable. When you're at that Venn diagram in that moment, that's when really innovative, great products happen. And I think a lot of people spend a lot of time thinking about the technology side and the business side, but not enough about the desirability side. What is that deep, latent kind of human need that you're touching on, whether it's an enterprise product or a consumer product? Because if you do that, then you're onto something really special.
Absolutely, that's helpful advice there. Uh, let's talk about the opportunities and bubbles that you have identified uh, in the venture capital investing space.
Yeah, I think, there's always bubbles happening in startups and venture capital, right? And the important thing is to recognize if the bubble, where you are in that cycle of the bubble, and when you want to enter and when you want to exit, right? I think one of the biggest bubbles happening right now is on the generative AI space. AI is hot, AI is real. My point of view on AI is that, if we, in 5 years, AI is going to feel like electricity. It's just there in the background. You take it as a given. It just magically happens. It's not something like a product I'm using. It's just in the background, right? The way, cloud services, all these things just magically happen. You don't think about it. But today it's like part of the conversation, right? It's kind of front and center. And so I think there's a huge bubble happening right now on generative AI and these LLMs that people talk about, these large language models, etc. And I think it's good in the sense it brings attention to it. It kind of opens the aperture for people to think about what could be in the world and dream. I think it's dangerous in the sense of people are raising lots and lots of capital very, very quickly. And, expectations are quite high in terms of what could be delivered, will perform. And that's with every bubble, right? If you look at Internet 1.0, this was happening with the emergence of the web. And I think we're sort of in that moment and cycle now. So I think that's a huge bubble that's happening. I also think there's another big bubble happening in verticalized AI. Everybody thinks that it's funny, if you're working deep in a vertical in an industry, like let's say legal or something along those lines, right? Every lawyer I would talk to say, "Oh, in the vertical AI world, like this will never be disruptive. In the legal industry, right? Everybody not in the legal industry says, "Oh, absolutely, legal is going to get disrupted, right? Or accounting or whatever." So if you're on the outside, you think it's definitely going to. If you're on the inside, you're like, "No way, no way." But I do think there's a bubble happening where people are just automatically assuming all AI will be this sort of labor arbitrage and it will swap it away. And I think that that is true in parts, but it's not a one to one, right? And I think that's something people should really think about. Of like, I think AI will enable people to do more, and I think that it'll allow people to do more output. But I think people have to be careful to think that, oh, all of a sudden all of these sort of knowledge worker type jobs are going to disappear immediately.
Absolutely, yeah, that's an important nuance in that discussion. Awesome. Let's talk about the other side of Series A, the founder side of Series A. How should founders approach raising Series A?
Yeah. Well, I think anytime you're fundraising, which is Series A is a part of fundraising, right? It's an event fundraising. You're always selling a dream, right? You're selling a dream to investors. You're telling them of a potential future that could be, you know? So I think at this pre-seed, seed, Series A, B, founders have to really be thoughtful about, well, what dream am I selling today? I have my big vision for the world, right? But what dream am I specifically selling today? And I think Series A, going back to this idea of it's a unique time in a company's journey, because when you raise a Series A, you're sending a big message to the world. I want to build a massive company, right? Because you're taking on now significant capital. And you're saying, okay, I'm going to go on this long journey, not a 5-year journey. It could be a 15-year journey. I'm going to dedicate a significant portion of my life to this journey. And then my goal, if I get this all right, from a financial perspective, is to have a multi-billion-dollar outcome, a large public company, or a huge, huge outcome, right? And so you have to really convince investors that you are capable of doing that you have a unique point of view on the world. Oftentimes, I think people, when you look at big Series A's and sort of companies that have been successful, kind of looking at the history of those companies, they go from market taking companies, just taking market share, to really reshaping a market, creating a completely new behavior, right? So, like if we take Uber or Ola. right? People are like, oh, taxi cabs, this and that's a small market, but it really reshaped what mobility meant, right? Now it's like, oh, I can actually, my frequency of usage of these apps is much, much higher than it would have been if had it taken a taxi or what have you, right? And so I think the best companies that are Series A's go from telling a story of we're going to take a little bit of market share, but then we're going to reshape this entire market. And I think also the really great Series A companies often dominate small markets that then ride a wave and grow. It's like they're taking a tailwind and going very, very fast with that tailwind. Because oftentimes, when you look at Series A companies, going back to what makes great products, the great product hasn't been built yet. You've only raised a little bit of money. You've only been at it for a little bit of time. Highly unlikely you're going to be building a Ferrari in like 2 years and being like, it's perfect, right? It's going to be rough around the edges. Probably won't work all the time. Probably be a little bit frustrating to use. But the market pain from the consumer or the customer is going to be so high. They're like, I have to use this product because nothing else solves that pain.
Absolutely, totally agree. Uh, let's talk about now the investor side of Series A, right?
Yeah.
So, how do you determine if a company is truly Series A worthy?
Yeah. So I think I'll start off by saying, like, for every investor, there's probably like 10 opinions. It's like it's exponential. Like, what justifies a Series A, right? Even within our portfolio at Nava, there's a huge variety. Some companies are monetizing or post what they call product market fit. Some companies are still, five, six people with like a brilliant idea executing and building that widget. So it's a very broad spectrum. What we like to look for here at Nava is what I call founder market fit. And on the founder side, we really spent, because that's very subjective. Like, what makes a great founder? It's very subjective, right? Um, we like to look for what I say is like founders should tell me a secret. Tell me an unknown about a market. Tell me the thing that's non-obvious. If I know more than you about a market or your space, I'm definitely not investing. You spend thousands of hours thinking about this problem. I spend 10 hours thinking about it. So that's really important. And spending a lot of time understanding, okay, this founder can tell a secret, but can they build, right? Because you're going to be hiring people that have great jobs elsewhere, Google and Facebook and what have you, right? Why is somebody going to jump to your company? Do you have the ability to recruit great talent? Do you have the ability to fundraise? It's asking a lot of somebody. And so you really want to spend a lot of time at the Series A looking at who they are, who they have been where they've overcome adversity, where their network is, and can they execute well. And then on the market side, in this founder market fit equation, you know, is the market big enough? I think a lot of companies are great companies, but they're not operating in venture scale markets. And what I really like to look at is, okay, in 10 years, could be a small market today, but let's say in 10 years, could this market support hundreds of billions of dollars in value? Is the market growing? Is it becoming something that is ubiquitous? And if it's a growing market that can get to that scale and size, that's pretty interesting. So we like to look at, okay, is there founder market fit along those dimensions?
Absolutely, totally agree. And I've heard a lot of early stage or probably earlier stage investors talk about it who are doing seed, talking about founder market fit. I think that's probably also the most important thing at that stage because that's the
Yes.
only thing you can probably see at that stage, evaluate, right?
Yeah.
But at Series A, I would assume there'd be some more details about how the execution has been. So tell me more about how you evaluate that aspect, that how good the execution has been, and is that company approaching that escape velocity to scale from here, right? How do you evaluate that?
Yeah, absolutely. I think one of the dangers that's in the market right now and a common mistake of founders is everybody has blog posts and websites about like, here are the great metrics for Series A, right? And they're like, oh, such and such 1 million ARR, such and such NDR, et cetera, et cetera. And I think it's very dangerous to back a company into those metrics and say, well, now I'm ready for Series A because the most common mistake I see great founders make is thinking about the quality of the revenue. They just focus too much on that and they don't think enough about like, okay, where is this revenue coming from? They just think about the quantity, excuse me. So 1 million ARR, let's take that example, right? 1 million ARR. Like, is that 1 million in ARR from 20 customers that are really representative of the next 20 I want to grow? Is it one customer who's kind of my friend that works at like at Walmart and just did a favor for me, right? I think it's really important for founders at Series A to have, maybe tried a few customers and also fired customers, right? I think one of the things I talk to my team a lot about here is I think revenue is for ego and gross margin is for intellect, right? It's really important for us caring less about the top line metrics of revenue, etc. It's part of the equation, but it's much more about, okay, is this a strong gross margin business? Is that good unit economics? If I repeated this business time and time again, would it scale, right? Is there a repeatability there? Because I could, over the next week, I could build $1 billion revenue company if I just sold iPhones for $1. It'd be a terrible business, but I could generate $1 billion in revenue, no problem, right? So I think that's something that I really would encourage founders to think about when they look at these metrics of like, okay, what really makes sense for my business, and not just from a moment in time of a Series A, but over an arc of time. It's hard to think in 10 years, but maybe over a period of 2 or 3 years, if I really did start to scale my business, is this the kind of revenue and what shape does my business start to take?
Absolutely, yeah. Very valuable advice there.
Mhm.
What are the most common mistakes that you see founders making?
I think the biggest one is just thinking like if I hit certain metrics, then I'm fundable, right? I think the other thing I think that is really common is founders don't take enough time to get to know investors. It's kind of weird. Sometimes you meet a founder, they have a hot deal, quote unquote, and it's Monday, and they're like, okay, I'm meeting you on Monday, I'm closing on Friday. Are you in or out, right? And that's really dangerous. I've seen founders, most founders take longer to interview employees than they can do to interview investors, right? The difference is I can fire an employee that's not working out, right? It's very difficult to fire your investors because they own a chunk of your company, they're stuck on your cap table, and they can be actually very destructive to your cap table. I've been in many conversations where I've seen venture capitalists actually do more harm than good, and not because they're bad people, but I don't think they're the right culture fit for that founder. The founder did not take the time to interview the investor, and I think oftentimes founders forget the investor has a portfolio. The founder is like, this is like the one thing I have to make this work, right? So I really encourage founders to take time, not a week, like I would say multiple weeks, get them, or even over a year. Like start to reach out to people when you're not fundraising, get to know them, see if they take your call, spend time with them. Don't do a rushed process. It's actually quite dangerous. The other thing I think founders should really spend time in thinking about is if this company works, am I winning with this investor? I think oftentimes people take money from amazing firms that are very fancy, but if you're one of 2,000 portfolio companies, when do you start to matter, right? And this is just human nature. If I invested, $500 million in a company versus 10 million, right? Because I have a growth stage investment versus a 10 million, you know, what am I going to spend more of my time thinking about? Right? It's human nature. On the investor side, you probably spend more of your time thinking about the $500 million check you invested, not the $10 million check. So I think sometimes if entrepreneurs slow down a little bit with these conversations, we're more deliberate and systematic. I think they could actually find investors that are better matched for them because there are so many investors in the market today, and no investor can do it all.
Absolutely, I completely agree. Again, great advice. Uh, Now let's talk about portfolio construction. How do you approach that at Nava Ventures?
Yeah. So as I said, our first fund is 175 million. We only do Series A. So and then from a geographical focus, we are U.S. focused, North America primarily, and in tech. And then we in that first fund, it's concentrated high conviction bets. So we're going to do about 15 deals plus or minus, and that's important because it's less about the dollar amount, but it's much more about thinking deeply about your time and where you want to spend time. And I think for us, I think the fund size really shows the strategy of how we like to operate, of being, moving deliberately, being very thoughtful versus sort of, well, spray and pray, let's try to get some logos and see if something works.
Absolutely, completely agree with that. And talking about value add, how you help companies succeed, we have touched upon that a little bit, but if you want to go deeper on that.
Yeah, absolutely. I think investors, if you're a venture capitalist, everybody's got a great network and some set of experiences, right? And I think, you know, what's most important for founders as they pick venture capital investors, there's the capital piece of the equation, but much more so is, are those investors helping you become your best self? That idea of like kindness that we talked about earlier. But like, can this founder, are you helping them lean into their strengths and recognize those strengths and go faster with those strengths and having honest conversations? The number of founders I've met, including some of my friends, that have taken money from some of the titans in the industry. You're like, oh my gosh, I've got such and such person from a Greylock or Sequoia on my board. They've been in venture for a decade, couple decades. They're legendary, but you can't actually use their wisdom because you don't say the honest conversation. You're actually putting on a performance in the board meeting of everything's great, even if it's not. I think the thing that's really important about value add as an investor at this stage is building a relationship with the founder and having them have a conversation with you where they say, I don't know the answer. That's okay. I may not know the answer either, but we will work the problem together. And that's critical because most companies aren't one-to-one identical. So the problems that you're facing are unique. There's some patterns around it, but then being able to work the problem together with that founder is critical.
Absolutely. So my last one before we go
Yeah.
for the rapid fire round, and this is about what's been your biggest learning investing in startups over the years?
Oh yeah, so many. I have no hair. I think everything is harder than you think. I think if you're doing something great and something impactful, it is very hard. And so building a strong team of folks around you at the management level, at the advisory level, on your cap table as you take on money, having more people on your team, so to speak, and your extended team is critical. Nobody can do it all. Having expertise in different pockets, thinking hard about that, because everything is harder than you think. And especially when you're trying to build something that changes the world or has huge impact on the world, there's going to be so many unexpected problems. And you want a team of people that's on your side to help navigate those problems, right? That's one of the things that I've seen time and time again that great entrepreneurs do well.
Absolutely, yeah, I completely agree in that. Now let's do the rapid fire round, wherein I'll ask you 6 quick questions about the
Okay.
investing you're doing, and you have to give 6 quick answers.
Okay.
Ready? Okay. So the first one is, what are the sectors and regions you invest in?
US, Series A, tech, enterprise, and consumer.
Great. What's the typical stage of investment?
Series A is all we do.
Okay. Do you lead rounds?
We lead and co-lead rounds. Yes. We don't have to,
Okay.
but we like to.
Okay. What's the typical check size you put in?
5 to 10 million.
Okay. Where can founders get in touch?
They can email me at Manish, Manish, at Nava, Nava.vc.
Awesome. Last one, where can our listeners follow you?
Yeah, they can find me on LinkedIn and also our company website on LinkedIn as well by just searching for Nava Ventures.
Awesome. I'll make sure to put all those links in the show notes below. Thanks so much for doing this, Manish. It's been a very insightful episode. I wish you all the best. Happy investing.
Thank you so much, Prashant. It's been a lot of fun.
Thank you.